Hello, everyone. I'm David Widmar, managing partner of Agricultural Economic Insights. And I'm joining you here today. It's September the 1st, 2023, and we're wrapping up the summer. We're thinking about a In Case You Missed It newsletter for our weekly readers for the AEI.ag newsletter. And as we're thinking back through this, and we're also starting to prepare for our winter and fall outlook meetings that Brent and I are going to be doing, there's a couple articles that really stood out to us that I think has a lot of implications for the farm economy, but also the situations, the decisions that producers are going to be facing and having to make and navigate here in the next few months. And I want to spend just a couple minutes talking through one slide that has two charts on it that I think are potentially the most important to keep in mind when it comes to the farm financial economy. So the first chart here is on the right. This is the what we call the Farm Machinery Debt Index. And what this does, this is a measure that we put together at AEI that says, given the data that's available about interest rates and repayment periods, what is the annual cost to service $1,000 of farm machinery debt? And as you can see, this was really high in the early 1980s, and that was because we had short repayment periods and really high interest rates. And as we move forward, we had repayment periods kept getting stretched out, and interest rates came down, so this index continued to fall. What we've seen here in the early parts of 2023 is we saw higher interest rates. That's not a surprise. Everyone knows that we have higher interest rates throughout the entire economy, but the index didn't tick higher. And why did they not tick higher? Well, when we looked into the data, we've been stretching those repayment periods even further. And this is really important because as producers maybe review their CapEx plans, as they start to manage their year-end activities, they might be going in and looking to replace a piece of equipment. And if they're looking at financing options, they might notice that the payments haven't changed all that much. And this is kind of this proverbial used car salesman tactic. What we want to encourage producers to do is to avoid that level one observation, which is payments are about the same as they were last year. And last time we were buying a piece of equipment. What we want to do is we want to engage that second level thinking and really dive into this. And in the articles that we've written, and I've linked to below, we've really looked at how long those payments have been stretched out. And you can see that even in the last 18 to 24 months with higher interest rates, we've been stretching that out. And there's been a bit of an offset. Now, the other side of this is sort of this idea of what happens when we kick the can down the road, what happens, what are the trade-offs that have come because of these longer repayment periods during higher interest rates. This is the total cost associated with the total debt expense associated with $1,000 of farm machinery debt taken out in that given year. So as you can see, during the 1980s, high interest rates, and even in the 90s, higher interest rates than we saw today, pushed that lifetime interest expense up, getting as high as $120 to $140. Then we saw that start to decline because we had low interest rates, especially throughout the 2000s, and then we've seen a really big jump higher here in 2023. Now, interest rates aren't nearly as high as they were during the 1980s or even part of the 90s, but what's unique here is this really long repayment period. So with long repayment periods and moderately high interest rates comes really big interest expense. So one of the things I encourage producers to think about here is, okay, what does the lifetime of this loan look like? We could find ourselves into a situation where 3 or 4 years down the road, we go to trade in this piece of equipment, or we go to buy a new piece of equipment, and we might find that we don't have as much equity as we thought we would have had on that trade in, or we might find out that we're still making payments when we're usually getting ready to buy a combine. We're still making tractor payments. So, given this change in the interest rate environment, we have to ask ourselves, how are our businesses going to be changing, or how do we need to be positioning our business differently? And we need to keep in mind these longer repayment periods. Of course, the other thing that's going on here is if you're in a rotation where you're constantly updating a new piece of equipment every few years, you're going to find there could be a lot of payments starting to rack up, especially down the road. So again, this is sort of an issue that's the seeds have been sown for this. We want to be managing it. We want to be keeping an eye on it as it moves forward. And again, I'll share the links to some of those articles in the in the description down below. But higher interest rates, longer repayment periods, that's made it more affordable here on a payment basis, but it's going to impact us down the road in terms of total interest expense, but also the number of payments that we have to make and how that might be impacting our CapEx plans in the future and our debt service obligations in the future. So wishing you all the best here as the summer wraps up. Want to provide these insights to give you a heads up or a bit of an advantage or an edge as you start to make those own decisions for your operation, or maybe you're helping growers make some of those decisions. So hopefully this has been insightful for you. Encourage you to check out the articles at aei.ag. And if you're not already, to subscribe to AEI Premium. Until next time, stay curious.